Welcome to another edition of the Macro Minute. I'm Jeffrey Cleveland, Chief Economist here at Payden & Riegle Investment Management. The topic for this week, does wage growth cause inflation? Well, it seems to be a foregone conclusion in the marketplace that the economy is getting better, that the labor market is tighter, that wage growth is accelerating, and that's going to feed through into inflation. The Fed is going to be caught off guard by this and be forced to hike prematurely. We think that's wrong. We think the question that investors should be asking is, does wage growth actually cause inflation? And there's two ways to approach it. One is from a theoretical standpoint, and the other is from the empirical evidence. In theory, a worker can command a higher wage because they're more productive, because they're producing more output per hour. And their company, their employer, is going to be forced to pay them a higher wage. And that company cannot just pass on this cost to the buyers of products. That's not how the world works. So in a theoretical standpoint, or from a theoretical standpoint, wages don't cause inflation. When you look at the empirical evidence, yes, wages and inflation are highly correlated, but it's a bit of a mystery, the direction of that causation. You can actually get in a situation where average hourly earnings or wage growth accelerates to 4.5%, like we saw in the 1990s, in the mid-2000s, and inflation doesn't necessarily follow. So you can have rising, accelerating wage growth, no inflation, or very low inflation. And so, contrary to the common theme out there, the very popular theme out there in the marketplace, that wage growth is going to cause inflation and force the Fed to tighten, we think it's not a bad omen if wage growth picks up. It's good for the economy, and it won't necessarily cause inflation. That's the Macro Minute for this week. I'm Jeffrey Cleveland.